Welcome to the Central Banking Panel. As you've just heard, we have three wonderful panelists to present this morning and discuss. The way we're going to structure the panel is we're going to have short statements by the three panelists, and then we'll have some questions, and then we'll turn it over to questions from the floor. So we'll start with Governor Zetti.
Good morning. I'm also a graduate, and I think Governor Kim and myself were at Penn during the 70s, and I graduated in 1978. So let me first of all congratulate the Wharton alumni community in Japan on this highly successful alumni program. It is with great pleasure that I have this opportunity to participate in this event. This panel on the changing role of central banks, every crisis has prompted a review of the role of the central bank, even after the Asian crises and previously during the ERM crisis and now the global financial crisis. Several reasons have prompted this ongoing current review by the global community. For central banks with just the single objective of monetary stability, a number have now been given the financial stability mandate. And this is in marked contrast with the crises in Asia in the 1990s, where the financial stability responsibility was taken away from the central banks. And for those central banks that have the financial stability mandate, the review on their role is on the scope and reach of the mandate. Of course, there were gaps, like in the US, the investment banks were not regulated, and now they look at the role of shadow banking. And so the discussion now in the international community is how far and to what extent the reach of the central banks will be, so that we have consistent oversight on the overall financial system, and we also want to avoid regulatory arbitrage. In my own country, in Malaysia, you see as soon as you tighten the regulatory oversight, there's a gravitation towards the less regulated segments in the financial system. Then there is the international dimension of policies. The world, we know, is becoming more interconnected and interdependent. How then is this being addressed when policies are based on domestic considerations, when it is all also based on national interest? So in determining the most appropriate institutional structure, there must first of all be great clarity on the objective that needs to be achieved. And I think this is where the problem lies, the lack of clarity in what is really aimed to be achieved. And this brings me to the second part of my remarks, the definition of the mandates of central banks. At the outset, it needs to be recognized that monetary stability and financial stability is a means to an end. The ultimate objective surely is growth, development, economic well-being of our communities. Let me start with monetary stability. Clearly, it is defined by price stability, and there are, however, different approaches in achieving this common objective. Inflation targeting, the central bank I come from has never done inflation targeting, and we've always been highly criticized for not doing so. We all, by the IMF and by others in the international community. We have an alternative framework that allows for greater flexibility to examine the sources of the inflationary pressures, to look at whether it's demand or supply arising from demand or supply shocks. and then to consider the risk to growth. We're not going to run inflation run the economy to the ground just to low inflation, and then to also consider the risks of build-up of financial imbalances, and this usually happens when interest rate levels are very low, and when interest rates are too low for too long, this results in financial imbalances. What are these? Well, mispricing of risks, disintermediation to other parts of the financial system, and build-up of and formation of asset bubbles, and so on. So monetary stability, of course, there's a consensus what the purpose is. It is an important precondition for growth and progress. Monetary stability for us, legislated, is monetary stability in an environment of sustainable growth. And as our discussion probably here will show, that it's important to recognize that monetary policy on its own cannot achieve the ultimate objectives of growth, sustainable growth, and stability. And we cannot secure this on its own. Other policies are very important. And because now we see the issues of fiscal sustainability and other issues of structural adjustments that are more painful, that are needed to take place in several of the economies, that there's an over-reliance on monetary policy. But monetary policy can just only do so much. Let me turn to the other important mandate of central banks, and that is financial stability. And the most compelling reason, I believe, for central banks to be accorded the financial stability function is that central banks are lenders of the last resort. So the central bank needs to be well positioned to make the assessment on the viability of the institutions, whether it's a liquidity issue or a solvency issue. So in an environment of rapidly changing conditions, the information between the supervisor and the supplier of liquidity, the central bank, needs to take place. In our own experience, when we had the Asian financial crisis, it had to take place 2 or 3 times during a day because the environment was highly dynamic and rapidly changing. And if you have this role being fragmented across agencies, it will become less efficient in terms of the information flows. So the argument is that it should reside in the central bank. Now, unlike monetary policy, it's less clear. What is the objective of financial stability? How is it measured? How do we know that financial stability is being achieved? When we rewrote our Central Banking Act in 2009, we legislated the definition, and I'd like to share with you. And I believe that we were the only central bank that legislated the definition of financial stability. And this, more recently, the Bank of England has done so as well. So financial stability is defined as that financial intermediation continues to function without disruption. And we saw in the United States, for example, what happened, and in Japan previously in its lost decade, what happened when the intermediation function was disrupted. And there are many indicators that can measure this in terms of credit flows, tightening of underwriting standards, and all these are being monitored to see that financial intermediation is not at risk of being disrupted. The second one is that there's an orderly functioning of financial markets, and you look at spreads, market turnover, market liquidity, and so on, and volatility trends. And the third and final part of the definition is confidence in the financial system. And this you can measure by patterns of deposits, withdrawals, and share prices of financial institutions that are listed, and institutional soundness in general. So a clear definition allows for the assessment of performance in safeguarding financial stability, And more importantly, it allows for greater accountability, because as having the role of maintaining and safeguarding financial stability, we can be measured just like monetary policy by the rate of inflation. How could central banks influence financial stability? Well, we need, of course, to be accorded with the powers, and many central banks, the Federal Reserve Bank, the Bank of England, maintained that they didn't have some of the powers that were necessary for financial stability. And then, of course, setting the prudential rules, the supervisory oversight, whether it's light touch, that is allowing the market to do more of the disciplining, or like in Malaysia, it will be intrusive, highly intrusive. And then second, finally, to rely on the boards. The boards of financial institutions also have to perform their role in overseeing the risks that are entered into by the financial institutions. The final point that I'd like to make is the international dimension of policy and role of central banks, because of the greater connectivity, contagion, and thus interdependence. And globalization of finance has intensified during this decade, and the policy, however, tends to be national-centric. And we saw during the crisis, interest rates were brought down to an unprecedented historical lows. Fiscal expansion took place during this recent crisis to account for about 4% of GDP, and wide-scale financial reforms are being taken. I mean, when the crisis happened, at the early part, there was coordinated action on all these areas of lowering interest rate, fiscal stimulus, and the regulatory reform. But as the crisis went on, we didn't see this more coordinated interventions by central banks. And then for us, of course, in the emerging economies, the global policy spillovers are transmitted rapidly to our economies. So what do we have? We have in Asia come together as a region, and we are now in a better state of preparedness. We have also the tools to manage the highly volatile capital flows. We have more developed financial markets. We are more liberalized that allow for two-way flows. We have more flexibility in the exchange rate. We have buffers, built up our reserves. We have stronger financial systems, and we have structures and mechanisms to act more cohesively. So yes, most of Asia has been affected by this crisis, but we have been able to remain relatively resilient. Thank you very much.
Thank you, Governor Sethi. Governor Defakula will speak next.
Ladies and gentlemen, when the MC introduced me as Wharton grad of year 70, I feel old right away. So in the future, when you introduce me, just Wharton grad is enough, okay? When Professor Allen approached me, he sent a sort of, a theme of the seminar. In short, he simply asked whether inflation targeting alone is enough to assure the long-term stability of the economy or not. The answer is simple. Low and stable inflation is a necessary ingredient for long-term stability of the economy. However, only low and stable inflation alone should not be enough to ensure such stability. The economy could be disrupted by problems in the financial market, or when financial institutions incurred huge loss and could not function normally, even though with low inflation. And to prove my point, let me bring your attention to what's going on in the past 3 crises in the past 16 years. Let's start with the year 2007 in the US first. At that time, inflation in the Western world was relatively low and stable. But the financial sector in the US was growing very fast. It had outgrown the real sector by about 3 times for the past 20 years. This scenario was caused by the imaginative introduction of derivatives of various kinds. The overcrowded investment in certain types of derivatives by financial institutions finally caused the market to collapse in the year 2007. The huge losses which occurred in the said overcrowded investment led to the collapse of quite a few gigantic financial institutions in the year 2008. It also led to a financial crisis and economic recession in the US and Europe thereafter. These are simply because before the global financial crisis, there was consensus among academics and policymakers, including the US Fed, that the benefits of risk reduction and risk diversification provided by derivatives and securitization were significant and contributed to economic growth. They thus allowed them to grow unchecked and neglected the basic fact that overcrowded investment and similar positions in some particular derivative could create serious systemic risk. Added to the problems were failures in financial regulation and supervision, including the complex and overlapping structure of financial regulation. Especially in the US, regulatory gaps led to the rapid rise of shadow banks, for example, SPVs and non-bank mortgage origination companies, which were largely unregulated. There were also large information gaps. The Fed, for example, had no picture of the size of aggregate investment in each type of derivatives and could not properly assess the potential damage that could arise from these positions on the system-wide basis. But above all, policymakers in advanced economies had too much faith in self-regulating properties of the market. I still remember the days in the year 2004 and 2005 in one or two of the central bankers' meetings when central bankers from Asia, including Governor Sethi and myself, tried to suggest to the Fed to follow up on the activities of the fast-growing hedge funds, which might lead to financial bubbles, to which Mr. Greenspan responded by arguing that there was no need for the Fed to do anything because, in his belief, self-regulation was the best way of supervision. They never advocated for a regulatory body to closely monitor the financial institutions in their investment activities, no matter how large they are, and believed that by self-regulation, the invisible hands would function well. I leave it to you to judge whether the invisible hands did function well or not. Going back a little bit further to the year 1997 when the financial crisis started in Thailand. At that time, the inflation in Thailand was also relatively low and stable, and the Thai economy was growing very well. Authorities didn't pay enough attention to asset price bubbles. A lot of borrowings from overseas in foreign currencies was made without hedging to invest in the overheated real estate sector. The fixed exchange rate regime was blamed as the main cause of the non-hedging US dollar borrowings, which lead to real estate bubbles. That was partly true, but to me, another major weak point that led to the bubbles was the behavior of the financial institutions, which was lending without proper risk management by any means. Central bank supervision was not strong enough to counter the very risky lending activities. That was why the bursting of the real estate bubbles caused a large numbers of finance companies to collapse and quite a few commercial banks to close down or restructure. Recent developments in Europe also prove that fiscal imbalances could cause financial instability, which affect the economic well-being of many countries, even under a low inflation scenario. From the incidents mentioned above, it is quite obvious that keeping inflation low and stable was not enough to assure the long-term stability of the economy. To ensure the stability of its financial system, besides trying to achieve inflation rate in the targeted range, the central bank has yet to monitor other developments: the movement of asset price, the abnormal capital inflow as well as outflow, the happenings in the world financial market, including stock exchanges, which could affect the financial stability, the size of public debt and fiscal imbalances, for example. The central bank has also to make sure that financial institutions are in good financial standings with good risk management, and thus able to withstand the impact of financial instability from outside. The Asian Central Bank did that after the 1997, and the ability of Asian financial system to withstand such impact was witnessed in 2007 and 2008 when there was financial crisis in the US, and lately when there was series of crises in Europe, respectively. In recent years, more advanced economies have introduced a quantitative easing policy to jumpstart their economy, starting with the US and followed lately by Japan. The policy has had a spillover effect into countries in Asia, which have experienced a continuing capital inflow of large amount. Our central banks cannot just take care of inflation only, but has to make sure that too much capital inflow would not lead to asset price bubbles and would not put pressure on our exchange rates to strengthen beyond economic fundamental, too much to the point that impairs the competitiveness of our export. Actually, central banks in ASEAN have learned since the 1997 crisis and have not conducted policy with only a narrow focus on short-term inflation developments, but have followed the movement of various factors that may lead to financial instability, and also to make sure that their financial institutions perform well and are in good financial conditions. This will ensure that the financial system is resilient enough for the pressure from outside, as the more advanced economies are still struggling with increasing financial measures in various forms on their roads to recovery. I hope my talk today will be of some insightful information to you. Thank you for your attention.
Thank you, Governor Devakula. Next, we have Governor Kim.
Good morning, ladies and gentlemen. It is indeed my great honor to be here to speak. I'd like to thank the organizer for inviting me to speak. This morning, when I met Professor Frank Allen, he said as a moderator that he would like to open the floor for Q&A for about 20 minutes. I just found just 20 seconds are left for me to speak. And we Koreans are known to be the people who are always cooperative. And what that means is that I have to deliver a speech as briefly as possible. And two of my colleagues, previous speakers, already introduced very important points that central bank governors have faced during the past few years. We all know that we are in the middle of the global financial crisis. Of course, some of you want to say that we are at the closing moment of the global financial crisis, but I don't dare to do so. And Professor Allen gave a long list of questions that we can discuss for the session a couple of months ago. And I have prepared a lot to say, but what I learned was that time was rather limited. And so this time, I'd like to just say a couple of words on two different issues. One is on the issue of financial stability, primarily because we all face the global financial crisis for the moment. And secondly, I'd like to say a few words about the policies, the so-called, what we call QE or others, whatever you call. And I'm not going to comment on the policies per se that the key currency countries have conducted, but I'd like to say a few words about the impacts of ending or unwinding of such policies on the emerging economies. First, let me say a few words about the role of central bank regarding maintaining the financial stability. Just as Governor Zetti and Governor Prediation already mentioned and explained, monetary policy was the focus of the role of central policy up until recently, and particularly during the past couple of decades when we enjoyed the relatively stable inflation and modest economic growth, the period which usually termed as the period of great moderation. We found that as long as the central bank was able to maintain price stability, things would go well. But what we learned was that may not be necessarily the case. And what we learned was the following. First, the central banks have been endowed with, at that time, explicit mandates for price stability. But at the same time, if we look at the rules of the central bank in the past, the central bank is not a new institution. It has been with us for centuries, and other rules were maintaining financial stability and also doing a role of quasi like fiscal policy or like a quasi government, and. But what we learned was that even with stable inflation, the herding behavior and procyclical behaviors of economic agents can lead to a buildup of financial imbalances. And we now know that this was the cause, one of the main causes of the current crisis that we face. And another point is that the role of central bank in identifying and controlling risk factors in advance has been emphasized recently. And there a lot of discussions emerged whether or not the central bank was able to predict the coming of the crisis, and the central bank was able to provide remedies to cure for the crisis. And what we ended up with is that the central bank can do so by implementing or introducing several sets of macroprudential measures. I think if time permits, we will discuss that issue in a little more detail later. And another issue that I'd like to address regarding the financial stability is that the fundamental problem that we currently have is that even if we live in a globalized world or global economy, we know that we lack global jurisdiction. So if you live in an economy where you lack jurisdiction, the question is that whether you are able to maintain stability in whatsoever. So the question is, even though the whole world is becoming more and more interconnected and more globalized, we lack global jurisdiction. Of course, right after the Lehman collapse and the global crisis broke out, G20 wanted to serve a role of a global jurisdiction to a certain extent. And when all the members of the group faced the same situation, the spirit or the sense of cooperation prevailed. But when they faced different situations, it was found to be difficult to come up with a consensus view on some of the issues. And and let me say also very briefly a few words about, as I already mentioned, the impact of QE policy, or to put it differently, unwinding of QE policies on emerging economies. From a longer-term perspective, the impacts on emerging economies will depend upon whether the unwinding of QE and QE and exit strategy is sometimes meant to mean different things, but for the moment, let's assume that they mean the same. And whether the unwinding of QE is carried out in a synchronized or in a sequenced manner. Synchronized unwinding could in all likelihood cause a significant shock to emerging economies, given that about 70% of cross-border investment to emerging economies originates from advanced economies in which QE is currently being undertaken. Sequenced unwinding should be considered likely to cause a smaller financial shock to EMEs than synchronized unwinding, but it would push up the volatility of key currency exchange rates and pose difficult challenges to emerging economies in conducting their monetary policies, specifically as regards the timing of interest rate hikes. When it was only the United States which introduced this QE policy, it all depended upon how the US would undertake such a policy. But since after the United States, Europe, and UK, and now Japan all entered into the same game, and as we learned from the graduate school that marginal rate of return is likely to decrease if the amount increases. If more and more advanced economies enter into QE policies or into the regime of QEs, we know that their returns are likely to diminish. What that means is that the amount is likely to increase continuously. I think this is one of the issues which was mentioned by Chairman Ben Bernanke a couple of days ago. Anyway, what concerns us most is whether the unwinding will take place in an orderly or smooth fashion or not. Of course, as I said, as many countries have currently undertaken QE policies, it's not easy to expect them to do unwinding all at the same time. And so if they do it in sequential manner and as a sequenced, then the impacts are likely to be smaller, but the emerging economies are likely to be affected by high volatilities in capital markets and foreign exchange markets for relatively a longer period of time. Well, due to time constraint, let me stop here, and I'll be more than happy to discuss with you in more details about these issues later. Thank you very much.
Thank you, Governor Kim. The panelists have done an excellent job addressing the questions that I had sent them earlier, so let's turn it straight over to questions from the audience. So who would, yeah.
Good morning, my name is Naoko Miyake. I'm a class of 2009, and I'm a former economist at Bank of Japan. I would like to ask a question regarding the recent Bank of Japan's financial policy. How do you view the unprecedented easing? I believe that it has added some risk on the financial market, as we have seen recently in the stock market. It seems that the competitive easing is actually hurting other Asian countries. So especially I would like to direct this question to Governor Kim. And second question is that how do you see what we can work together to enhance the stability in Asia? We had worked together on the initiatives called Asian Bond Fund. What would be the next steps that we can work together? Thank you.
Thank you. Governor Kim, would you like to start on
Well,
that?
I should have made it clear. I always like to discuss the matters with others, but my rule is that I usually take the easier questions first. But this is an extremely difficult question to answer, and particularly as a central bank governor, you always have to make some statements as ambiguously as possible. This is a term former chairman of the Fed, Alan Greenspan, used to use, constructive ambiguity. And I hope I don't make destructive ambiguity, but let me say a few words. Yes, of course, this is an important point, and as you mentioned last in your statement, the cooperation among the parties concerned is crucial. And we all know that, particularly for those advanced economies. I mentioned in my speech that the QE policies are currently done by what we call key currency countries. And in the IMF SDR, there are 4 currencies in the basket. They include the dollar, pound, euro, and yen. And incidentally, these are the 4 currencies which have done quantitative easing policies. And other countries cannot follow the suit because the currencies of others are not used for the international transactions. But these key currencies can enjoy such privilege. And I don't think these key currencies can be compared to other currencies directly. And that is why I said in my speech that I wouldn't comment on the policies per se, but I said I would like to say a few words on the impacts of such policies on others, because we live in a globalized world, and all economies are interconnected. But as I said, we lack global jurisdiction. And so combining all these 3, what we can draw from what I said is that we need further collaboration and cooperation and coordination of policies among the parties concerned. And so the prospect is that every country should undertake a policy for his or her own objectives. Yes, of course, it can be done. But at the same time, as we live in a globalized world, global economy, we have to pay some attention to the impacts of such policies on others. This is termed what we call spillover effect, and we all know that there are always 2-way spillover effects rather than a 1-way. And so we have to avoid of being suboptimal by falling in a prisoner's dilemma. And so to avoid the state of a prisoner's dilemma, what we need is further cooperation.
Thank you. Governor Devakula, would you like to address that?
Well, I'm not the governor anymore, so I can be less ambiguous. I think the policy is good for Japan in short term, but it's bad for us in ASEAN. Because as soon as you done that policy, yen depreciate right away, and it affects our export competitiveness. That is a bit short, okay?
Is that it?
Yes. Well, I've been on record already to say that quantitative easing by the major economies now Japan can only be viewed as a temporary support. It is this monetary stimulus is important, and in the US it averted the worst. It restored stability in the financial markets, and but however, the ultimate objective we want to achieve is to restore growth and revitalize growth and generate employment. And this requires other policies. So this kind of quantitative easing buys time, and you need other policies. And to be fair, Japan has announced that it's only 1/3 of the policy measures. The other is fiscal measures to spur growth and structural adjustment measures to regain competitiveness. These policies must be undertaken because there's so much time that you can get from such quantitative easing. And beyond a certain threshold period, there's going to be other risks arising from this quantitative easing. And then in the meantime, as the other two of my colleagues here have said, that it has an impact on us. So far, we've been able to ride out the implications of these volatile capital flows and other aspects of these global policy spillovers on us. But there are also time limits to how much we can absorb. And so far, so good, but going forward in the future, we really need to see an optimal mix of policies that will generate growth and employment.
Thank you. Next question.
This question is to Dr. Zeddy. In 1997, in financial crisis, Malaysia took a very, very opposite measure even compared to Korea. Korea sold a lot of conglomerates or banks to the foreign capitals and opened the capital market, versus Malaysia close out and do your own thing. But many years later, actually, all the economists and the other people, in fact, start to appreciate what Malaysia took the measure in at the time in the financial crisis. So I'd like to ask you your opinion on central bank's role in total opposite measure that you took from South Korea, and you still in the same that mentality even now, or?
Well, it is true. We were told by the IMF to raise interest rate by 5%, and we didn't do that because we didn't think that that effort would result in inflows into our financial system, because we were experiencing outflows. Instead, it would damage our economy significantly. Then, of course, we did the famous controls to restore stability. But I've said many, many times that that was not the reason we made a recovery. It bought us time. It restored stability in the financial markets and allowed us to implement the other policies that were, and yes, we didn't sell off to the foreigners at that time. We set up a special purpose vehicle to recapitalize banks and take over some of the banks. And then when we recovered, we sold it back to the market. And that exercise broke even. So, of course, Malaysia, we've always been a little bit different, like we're not inflation targeting and so on. And but every country should do according to their own circumstances, because the circumstance, Korea is a developed country and they have different structures within the system in Korea. So what we did was to deal with our circumstances. Thank you.
Governor Kim.
Just half a minute. Yeah, I think the question was very appropriate. And let me say in a following way, there are 190 some countries in the world. They are members of the United Nations. Probably 230 are ahead of Korea, and 170 are behind of Korea in terms of economic development or in terms of per capita income. And which model to follow? Of course, Malaysia is an excellent, well-managed the economy. And Korea is, as Governor Zeti already mentioned, is much different from Malaysia in many respects. Korea has nothing to export. We have made economic development solely depending upon trade and others. So market opening and economic liberalization are the two key words that we have maintained in achieving our economic growth. And so even during the so-called the Asian financial crisis, or in Korea we call it the IMF crisis. We always blame the IMF rather than blaming ourselves. You know, if you take a look at the report of international institutions that have done studies, that there have been about 200 financial crises, and they are all named the names of the countries, but in Korea, we never said that there was a Korean crisis, there was the IMF crisis. In any event, in doing so, one characteristic is that we never moved backwards. We never moved backwards. In coping with and in overcoming the crisis, we never moved backwards in terms of market opening and economic liberalization. And so this is probably one of the indications to the less developed countries to achieve the economic growth. In case they have certain commodities to export, and if they have some endowments, of course they can utilize those resources for economic growth. But for a country like Korea, you know, that was what we chose was inevitable to us.
Yes, if I could add, actually, a major difference between Korea and a country like Malaysia is that we are 3 times more open than Korea. And in this recent crisis, for example, we saw a situation where the Korean currency, I believe it was in 2009, where it at first appreciated because of overshooting by about 30 to 40%. And then subsequently, when the reversal came, I think following Lehman's or the deleveraging occurred, the currency depreciated by 30 to 40%, and their reserves dropped by 70 billion. Well, if our currency, as when at that time trade was about 200%, 2 times the size of our economy, if we had swings of 30 to 40% in our exchange rate within a 12-month period, the whole economy would have been devastated. So, but even then, during that time, our currency appreciated by 12 to 13%, and then also followed by 12 to 13% depreciation when the deleveraging occurred. And our currency was pegged to the US dollar during the crisis to 380 to the US dollar, and it had appreciated to about 3. Then when this deleveraging happened, it went all the way back almost to 380. So for us, we want to see orderly conditions in our foreign exchange market. We're not trying to achieve any specific level, but it has to be orderly, and that is important. So that is a big difference. This is what we try to preserve.
Okay, we've run over time, so we should probably stop there. I'm sure we can could go on indefinitely, and hopefully during the coffee break the panelists can address questions from you individually. But I'd like to thank them all for an excellent session. Thank you.